All right, buddy, welcome to the Sherman Show. I'm Jeff Sherman here along with my co-host, Sam Lau.
Hey.
And Sam does not seem very excited today. So what we're going to try to do is bring a special guest on, Sam, and bring one of your favorite guests onto the show today. And he is none other than Jeff Mayberry, portfolio manager here on the macro asset allocation team. So welcome back as our most visited guest, Jeff.
Thank you. Thanks for having me. I don't know if I'm Sam's favorite guest, because when I'm on, he's got to talk more versus just ask questions. He's actually got to prognosticate.
Yeah, that's true. We make him actually earn his keep. And, now that you guys have more Monday morning minutes recorded than Sherman shows, I just want to make sure we congratulate you on that feat. So what happens when you record them every single week. You catch up very quickly.
Lose track, but one of the things that we lose track of too is the date that we're recording. And today we're recording on Monday, July 10th, 2023.
Yeah, I'm glad you said that, because I did listen to your Monday morning minutes from last week, and Mayberry did call it, he pulled a Sherman when he forgot to say the date. And so I hadn't got around to it, Sam, but since you wanted to front run it, why don't you front run the show and let us know what we're going to talk about today?
All right. Well, since we just passed the end of the first half a few days ago on this time of recording here, we thought we'd be good to bring back Mr. Mayberry to kind of do a wrap up of what he, some of his estimates and some of his projections that he gave in the beginning of the year when we recorded, I think around the third week in January there. And from there, after we'll start off with a scoreboard wrap up, see how Mr. Mayberry did. See if he's got any gravitas to stand on for giving us an update on the second half of this year as well. So with that, Mr. Mayberry, one of the big things in coming into 2023 was just trying to figure out what the path of rate hikes would be from the Fed. And at the time, we asked you what you thought was in store for us for the remainder of the year. At the time, you said that you're thinking 50 to 75 basis points seems reasonable for 2023. I can tell you right now through July right now, second week of July, you've pretty much nailed that part, but we still have another, how many more meetings? Is it 4 or 5 meetings left? Not including Jackson Hole, I guess. So is it 4?
I'll give you 4. I'll give you 4. Yeah, because there's 80 a year, right? Because they're every 6 weeks. So, and then they take a little bit of time off. And then as you said, we get the Jackson Hole too, which, historically, I think Jackson Hole was not really a very monumental event until one of Bernanke's speeches there, right? I mean, that's kind of where he alluded to like some of the, was it the taper tantrum? No, that had to start before that.
That was in May.
Yeah, that was in May of 13. So I don't know, there was one of them where he sat and like that became like the new place to kind of test out policy, or at least test out new thoughts out there on policy.
Yeah, I would say, I guess, I agree with you. In the last 2 years or so, it seems a little bit less uneventful, but we'll see now that we're coming back in full swings, and hopefully everyone's there on the spot rather than showing up virtually. Maybe we'll get.
Yeah, I think the one was the COVID one, right? With Powell, where it was like 14 minutes or something. It was like the quickest speech he's ever given.
Wasn't that last year where it was just like, you guys are way too bullish on rate cuts?
On rate cuts, yeah.
Trying to set that tone.
So what is the verdict, Sam? I think you put together a scorecard for Mr. Mayberry, and what does it look like?
Yeah. So, he had that 50, 75 basis points for 2023. I know at the time, it's pretty interesting in terms of the commentary that you provided to Mayberry. You're saying that when we looked at the world interest rate probabilities on work screen on Bloomberg, you're saying that based on that, the market was pricing in cuts by year end. But at the same time, this is in January of this year, the Fed was unanimous in no cuts for 2023. So what you said was to the effect of, I'm on the side of the Fed outside of a deterioration in labor market conditions. So I would deem that as a win thus far. We'll see. It seems like the work right now is, again, not pricing in any cuts for 2023 at this point. So
it's kind of a cut after a hike, right? So like if you look at it, it peaks out a little bit around the November meeting or so. And so I'll give him a victory on that too. And also for the lack of degradation in the labor market, right? So Mayberry, what do you make of last Friday's kind of jobs report too? I mean, the headline number was it was the first time in 15 months that it came in below expectations after that 14 months in a row of outperforming the expectations. But there were some really net revisions there that were pretty negative as well. So what do you kind of make of that jobs report, and where does it put us on the second half trajectory for the Fed?
Yeah, I think, it was a 209 was the headline, but as you said, there was visions downward. But I think you're still in it's like 200 is like the equilibrium level where if you have that many jobs, you kind of keep the same unemployment rate going on. So I think we're still on solid pace here. Certainly a little bit of weakness. Maybe people are starting to look at that and say, okay, maybe this the labor market weakness that I was about to say looking forward to, not really looking forward to it, but that we were expecting to come. Maybe they're starting to see some cracks in the labor market. And so normally we've been talking a lot about inflection points and whether we're at one now. And I think we're getting closer and closer to an inflection point now, just because the labor market maybe is starting to show some cracks.
Yeah. Yeah. I mean, look, it's, cracks. I mean, if we're talking about, still producing 150,000 jobs or so in the private market, it's still pretty strong there too, right? I mean, so even at these levels, it's not job losses. And I think what we've seen too is it's been pretty robust. It's been manufacturing, it's been the housing market, construction, things that people thought, a year ago with the hiking of rates would decimate some of those industries. And we continue to see hiring there, but also just this restocking of the services sector, right? Where, there was the off again, on again economy and starts and stops, for some of the service sector, and you're starting to see that replenishing as well. So it does sure look like, that there is some stability in that part of the market. And so, we're not seeing these, 400 and 500,000 jobs prints that we were seeing. But again, as you said, that we're kind of around that equilibrium point. So, it looks like, we're kind of on pace for that still. And I think, I fully agree with you that it would take, this deterioration to get the Fed to even consider to start cutting. And I think, but by the time they do, it's not going to be, 25 basis points or so. So, again, I think at this point, it's hard to really see how that happens by year end without just a really collapse in the labor market.
Yeah, I would agree. I would agree with that.
Yeah. All right. So what other prognostications did he make, Sam?
Yeah, so the next couple of things on the scoreboard, let's look at rates, specifically on the 10-year. At the time of recording, we were at about 3.4% on the 10-year. And your call, Mayberry, was from that point, you had said that the rates would go up. You don't think that you get past 4% on the 10-year. We're kind of there right now. I mean, we busted through a little bit, but we're right back to the 4% mark. But you did say that we would.
Screen shows 4.000 too. So I'm gonna say he missed it. Sam. We're gonna call him a liar over basis point, as you like to say around the desk. But I don't think it's a meaningful push up, and we haven't seen a new high in yield since like October of last year.
That's right. But one other thing that he did say too was that we would break into a new range that would be higher in the 10-year. So it looked like we got into that point for a little while, where you're kind of trying to break up, around the 380, 390 range. I don't have the chart in front of me on the 10-year. We certainly moved up into that trading range for some time in this first half of the year.
Yeah, I don't recall Mr. Mayberry forecasting that we're going to have a regional and community banking crisis either. I don't recall that in his forecast, so I think he missed that one too.
I mean, what banking crisis? I don't know what you're talking about. Rates are exactly where they were before.
That's right.
Beginning of March.
Yeah. No, it's pretty amazing to see that too. So, what do you make of the 2-year at this point too? Like, I mean, it's been fighting it. It doesn't really want to break out to that new high. We saw a big rally on Friday with the jobs report. What do you kind of make on that front end of the curve, and what's it signaling to you?
I mean, I think you look at it. I'll look at the screen. It's 486 right now. As you said, it was just above 5, or it got above 5 on last Thursday. I think that you look at it and you think Fed higher for longer. I think there's more downside there to the. I guess over the short term, there's more downside of the Fed continuing to talk hawkish, continue to say that they're going to stay higher for longer. But you could always get that, if maybe in the later half of the year, we get that deterioration in the labor market. And as you said, the Fed doesn't cut 25, cuts 200 or 250, then, you have a lot more upside on the 2-year there. So I think, your convexity is good at this point. So maybe it's okay to buy at 486. But certainly I wouldn't say just put all my eggs in that 2-year basket, even though that yield is looking pretty attractive.
Yeah. Now, when you think about that too, do you think we can see a 5 handle again on the 2-year, or what do you kind of think is the top end of that range? Because I want to pull you back on at the beginning of next year and get you committed to this. So
I think certainly, looks like market's pricing in, 90% chance of a Fed hike in 3 weeks or 2 weeks from now. So certainly that's priced in. I think that you do get Jackson Hole, and I think that Powell maybe speaks a little bit longer than the one we were referencing earlier. But I think he's going to stay in the higher for longer, no rate cuts, everything's strong. So I think you push up and you do get a 5 handle for more than just a day or two.
Yeah. Yeah, that seems to be what we had right before the what banking crisis, as you called it. And then, we got there last week, right? And just didn't really hold either. So definitely an interesting part. And at some point, that's the way the steepener is probably going to play out, right? Is the front end really collapsing down if there is this economic degradation.
All right, so let's move on to the next one here. The set it and forget it portfolio, at least for the fixed income side of your book. Maybe you came out talking about barbelling credit with some longer duration treasuries, given the move up in yield for treasuries. You're actually getting paid to take on some duration. It looked cheap. Credit you're still fairly comfortable with, but you thought there might be better opportunities down later in the year. With that, you did say that it'd be good to hold a little bit of slug of cash there, actually a healthy slug of cash, 10%. Is what you said in cash, and I would say it was T-bills that you're thinking of during that period of time at given the yield at the shorter end of the curve. So looking at it right now, credit is outperforming. Treasuries are getting hit a little bit, especially on the move that we saw after last week there. But it is tough to go against the barbell portfolio of this, especially when we're taking a look at it for more of a longer run 2023, 12 months rather than just the 6 months. But how are you thinking about things now?
Well, let me just point out real quick before he does say that, is that his cash position is actually a pretty decent win, right? I mean, you're talking about a 2-handle return on cash thus far year to date. And, now we're carrying, north of 5.25, 5.5, depending where you buy the bills at. So you definitely, even with that kind of conservatism, the conservatism is actually a very strong performer in that mix that you had there, Mayberry.
Yeah, and obviously you can never do enough of the good stuff, so should have done more cash. But I think the idea was put together your barbell portfolio. Don't go all in on credit, don't go all in on duration, and I think that still holds today because we haven't gotten the recession that people have been looking for, and so you want to continue to hold that duration side of things. You want to continue to hold that credit in case we do get the soft landing or softish landing or no landing. You haven't heard no landing scenario very often.
Although one of our marketing guys reached out to me this morning and said that the no landing story is getting a lot more traction. I said, from who?
Yeah. I mean, I feel like it's more of people are starting to feel a bit more optimistic about things. And so maybe this is the time. We'll get into the second half outlook, but I'm sure maybe it's going to be a little bit more of a, once everyone's in on the no landing, everything's okay scenario, that's when things turn.
Yeah, so I guess going back to, I think we talked about it on the show at the beginning of the year, was that, it's the most forecasted recession in the history of financial markets, right? And per usual, when everybody thinks something's going to happen, it doesn't. And it's right when people say it's not going to happen that usually it does materialize. So, I think that's kind of what you're saying there too. And if we start to hear more rhetoric about the no landing, maybe I'll borrow Sam's phrase, we need to buckle up and strap in,
Yeah. That's when we start to get worried.
That's right. All right. So then we move into the equity side of the portfolio.
Wait, so am I right calculating this, Sam, in my head? Like his barbell portfolio is probably break even with the cash portfolio, right? Roughly, it's probably in that. Maybe slightly better.
Yeah. I mean, you got the bank loans and the high yield, the cuspier side of credit, really driving the credit side of returns and fixed income.
Oh, that's what he was saying. He wanted to be 100% credit in the best performing sectors, right?
Right.
So,
Of course,
right.
of course.
yeah.
So
Okay, so
speaking
what
of that-
about on the equity market? So what was he saying on equities?
Yeah, for the set in and forget it equity portfolio there. He liked the setup of tech coming into the year, talking about how tech got their house in order a little bit sooner than some of the other companies in other sectors. There, they began layoffs a little bit earlier earlier than the others, mid 2022 and beyond. So he did like tech. He wanted to overweight that sector, and that's a big win. That is the best performing sector year to date here. I see it through today up 38%. Yeah, but the rest of the kind of the mega
I'm
caps.
gonna give him a golf clap for that one. That's a solid win there. So
Like,
very good.
that falls under the right outcome, maybe wrong process or wrong idea. I mean, wasn't thinking AI moving things, but outcome worked.
Yeah, which means you can still take that victory lap there. But
As we say, the destination, not the journey.
That's right.
So the cohort around that, we've been talking about the mega cap names, especially those around that might be benefiting from some of this AI mania as well. Some of those areas in there with comm services and consumer discretionary as well. Those are all up over 30% on the year. So I mean, definitely a strong showing from those three sectors that are really largely leading the S&P 500 up. We've talked about on Monday Morning Minutes. I'll give a little shameless plug there. How the other 8 sectors haven't really been holding their weight as much, but we'll see what the rest of this, what outlook you have for us for the remainder of 2023 next.
What is your shameless plug? I didn't get it.
Just what we've been talking about in Monday Morning Minutes, how really the S&P 500, a big driver of the returns have been these 3 sectors that really have the mega cap names, the S&P 7, S&P 8, depending on if you categorize Google as 1 or 2 names within that 7 or 8 thing. And then the remainder is just, it's been positive for the most part, but rather lackluster compared to both the S&P index returns and those 3 sectors.
You need to get with the times. It's not Google, it's Alphabet, man. Come on.
That's right. I still call it the Lehman egg sometimes, so I struggle.
All right. So I recall the 60-40 portfolio that Mayberry wanted to overweight bonds to stocks, right? How did that one fare, Sam?
Well, on the backdrop of that, it looks like equities are up, what I say, around 15% on the year, and then the ag is up about 1.25% through yesterday. So probably would have been better off leaning a little bit towards equities if you wanted to do the other way around, bro. Back to the original 60-40 with equity bonds, 60-40 there. But we'll get Mayberry's thoughts on the remainder of this year. Maybe he still pulls it through. So it's hard to judge a year's performance on 6 months.
I was gonna say, You said probably better off. Definitely would have been better off with the 60% stocks.
Trying to be nice with my words here.
As I was trying to say how awesome it was, you had 10% cash too. So when you expect a 15% return, the cash doesn't look as sexy anymore. So the biggest loser though, Mayberry, you were calling commodities too there, and you just didn't realize that there's a magnetic pull inside of that barrel of oil that just makes it gravitate towards 70, right? Goes down to 65, goes up to 75. I mean, for the last like little 2.5 months, it's just been stuck there too. We also don't have as much backwardation in the markets. The markets in general are better supplied. And I think a lot of the thesis was, at least I kind of shared that, for if you want the kind of, the reflationary type of trade, was the China reopening, which has just largely fell extremely flat too. So I think that's part of the blame for the commodity side. But you did say that you still like developed over emerging. So I'll give you that, we'll split the difference there and say that worked too. And, you still didn't, even though you're buying in the China reopening story, you're saying to play it through commodities, not through the equities, which, it fell flat, and both have really been just not very strong performers.
Yeah, and that was the talk of the town earlier, or beginning of the year, was China reopening at a COVID zero. They're just going to go back to huge numbers again, and now we were talking this morning. They need more stimulus because they have a lot of problems out there. So over there, so I still think if we get to like the no as we talk to the second half, if we get, if as we go into the second half, if we get to like the no recession type outlook, stocks up 15%, commodities were down, like 7% on the year so far. Like buy something that's down to get you that upside, versus maybe the thing that's been up 15% or 40%, depending on what sector or we're looking at.
Yeah, well, why don't we do that? Why don't we shift your outlook here then too? Let's go through it too. So let's start with, kind of how we think about things from a top-down perspective. We got a heavy week this week in terms of the economic calendar for the releases. All eyes are on CPI and the likes. Supposedly going to be the lowest print that we've seen really since the pandemic started in terms of year-over-year inflation. How are you thinking through the macro environment? Give us kind of a lowdown of what you see looking at your economic dashboard, and then further, what that translates into on where we are on the cycle.
Right. Well, this comes out on Thursday, hopefully, and so CPI will be out already. So we won't make any prognostications there, but we do have a 1.2 rolling off on headline CPI from last year. So everyone was talking about base effects last year in terms of the numbers were really low, so inflation is going to be higher. So we have the opposite working for this year. So this, the 1.2 coming off, and then after that we have a 0 and a 0.2, or 0.1 the next month. So pretty low numbers there. So it seems pretty reasonable that this could, if it's not the low print, it's very close to the low print of the year for headline CPI. But everyone knows that, or at least the Fed should know that. So they're not going to look at this number and say, "Oh, great, now we're done, mission accomplished." They're going to say, "Okay, we need to stay higher or keep rates higher, and see kind of things how things shake out." But really, you look at everything. When we do look at the dashboard, your manufacturing numbers are still very weak. Your PMI, your manufacturing PMI numbers are very weak, like 40, 46, 47, in that range. But services kind of keeps bouncing around. It's 53 today, been bounced off like that 50.5 or 50 point, if the 50 handle level.
I think it's 50 spot 4, I think, but whatever. 4. Yeah, whatever.
Yeah, it's still above 50, but not as good as it was.
But the service report was strong around, right? You had the uptick there, prices paid were down, you had new orders up on the service side. I mean, just in general, I mean, there was really nothing negative in that services report from the ISM last week, right?
Right. And so is it, historic, when you look back in history, you look at the manufacturing numbers, and it's very much like when those numbers go down, you get a recession. But has the economy changed, the U.S. economy changed enough that the services side, certainly the service side, is driving a lot, and is that really enough to sustain things? And it seems like that mix shift between manufacturing and services is something that when you look at the historical data, it doesn't show that mix shift. And so is that something that you look at that services data and say, you know what, things are going to be okay, or things have the possibility of being okay even though the manufacturing number is low?
I was arguing that with one of our PMs last year, where he was trolling out the data on the manufacturing and all these recessions that it's called, every single recession. I was like, yeah, but it's had a meaningful number of false positives as of late, and it's exactly what you're pointing out. And if you overlay the two charts and you look at them, I think that it's not a sufficient condition; it's a necessary condition, right? To speak math for a second, but ultimately, I do think that, once you get that dip in services, I mean, that is the lifeblood of the overall economy, right? And so, I think rightfully so, there's been some newfound enthusiasm, and potentially that's where, maybe one of our relationship folks was asking, about the no landing. Maybe that's where they were hearing that from, was the enthusiasm around the services data.
Yeah, and obviously, labor market, as we talked about earlier, still relatively strong. Unemployment rates, 3.6, so very, very low levels. If you pull up that chart, it was we've been in this. If you pull up a more recent chart, obviously you go back to those 1965 numbers, and unemployment was down around these levels, but it hadn't been these levels in like all the boom times that we saw in like the 90s and the early 2000s. And so the labor market continues to be strong, and so certainly the Fed is keeping an eye on wages, and with the labor market so strong and wages still growing but below inflation, they're really going to try to keep an eye on that and really see that as the thing that's going to turn. And that I would think that the Fed doesn't want to say they want a recession. They don't want to say they need unemployment to rise. They need wages to fall, but they do in order to get inflation back down. And so that's really what they're going to be focused on, the wages and the labor market overall.
Yeah, I mean, if you look at labor force participation, it's been pretty stable. But when you dig through the data, what you see is that working age cohort that they call the 18 to 54, I think it is, and that one continues to accelerate in terms of participation. We're above where we were prior to the pandemic, but there's been a hit on the 55 plus cohort, right, post pandemic, and we've seen that kind of stagnate there. So it is a different kind of composition mix within the age cohorts of that. But in general, I mean, there's a reason we call it working age population, right? I mean, that's got the 80+% participation rate. So in general, I think that, we just have to continue to focus on this. And there's been some kind of false starts. I mean, what's pretty amazing is the unemployment claims. They've risen, off their lows. They're kind of in a area that's above the pre-pandemic levels, but we see, even though they have this elevated initial claims, the continuing claims have been deteriorating, right? They've been going down. And so there is something that says that within this space that it isn't really this significant deterioration there. And so it seems to be either recycling through the population or those people are dropping out of the labor force. So again, it's hard to say that there is this kind of really erosion in the labor market at that point. I guess it's easy for us all to say, well, we still have jobs, right? Before AI takes over on us. But I guess if you don't have a job right now, it probably feels a lot different than what we're describing here. And so, kind of as you think about the rest of the economic data set, what is concerning out there? I mean, labor seems to be, still there. It is the last shoe to drop, as we all know. But what are you seeing across the rest of the macro landscape?
I mean, everything looks, I hate to say it, just given the company we're in, but I think everything looks good. The economy still seems to be chugging along. It seems like it's from that overall landscape, it seems like we always like to stay steady as she drifts. If the economy can keep on this level, the Fed will be happy to maybe raise rates a couple more times and just see how things go. And I think that it seems like the economy is pretty resilient. As we said, it kind of just sloughed off the banking crisis, a regional banking crisis, and said, let's keep going.
Yeah. Yeah. So, one thing that a lot of the naysayers have been looking at lately is the resumption of student loan payments coming and that. And so I know our ABS team has done some work there. How concerned are you about the resumption of these payments? As Sam joked, he said, well, it sounds like we're going to have delinquencies go up on all kinds of credit, not just on student loans, because they're zero today because you're in forbearance right now. But ultimately, do you think that is something that will continue to put pressure or put more pressure on the end consumer? And, also just, with cash rates being where they are, does this somewhat also curtail consumption a little bit where people are saying, you know what, it's nice to earn 5% by taking no risk?
Yeah, I think that's right. I think that it'll be interesting to see what the student loan resumption is, because it's been like 3 years since people have had to make payments. So you kind of forget, like, whatever, even if it's a couple $100s a month, you've been spending that money. And so now it's right. Like, now you have to curtail your consumption by that, whatever that dollar amount is. And certainly that's gonna hurt the consumers. It's gonna hurt consumption. It's gonna hurt, some people are gonna, be delinquent on their student loans. And, I saw something today that was like, well, of course they're gonna, not pay their student loans because they can't take your degree away from you. If you don't pay your car loan, they can repo your car. They can't repo your degree. So, I think, of course, then, it sticks with you though. So that's not great. You can't just, bankrupt yourself out of your student loan. But I think that it's certainly on the margin and certainly negative, and it'll be interesting to see how negative it is. And so, that could be the catalyst for some weakening both on the consumer side, and which would obviously, as we talked about, drives the economy.
So your view on recession in 2023 sounds like it's very low at this point.
Yeah, I think it's very low, just because it's, outside of the COVID recession that we got that just, happened out of nowhere. usually it seems like they take a little bit longer to get up to kind of to gain momentum onto the downside. And so, here we are, we got 6 months to go, obviously, and in the mid-year review. So I think things are looking good, or solid enough now that it's going to take some time for them to deteriorate enough to kind of for the NBER to really say, okay, we're in a recession.
Okay. And then the one thing that Sam wanted me to mention to you too is the thing that hardly gets any attention anymore, quantitative tightening. It's been pretty interesting where we looked at, we did this in our asset allocation meeting a couple of weeks ago, and we were looking at the maturity schedule of the Fed's balance sheet. And, at this point in the year, it was supposed to be where they wouldn't have enough treasuries rolling off to be able to do that. But it looks like some of this reinvestment they've done has been very short term. So now they have the ability to roll that off. It's pretty amazing that they're able to do that. And I guess it's not amazing, it's just math. You can figure it out. But I did notice also that for the May report on monetary growth, the monetary base actually increased for the first time in roughly about a year or so. So again, it's obviously probably all that issuance of bills to replenish the TGA. But as you think about it, is this just something that's going to go on in the background and it's there until we have the recession, or do you think at some point potentially this helps engineer a soft landing where they have the ability to kind of provide liquidity by not removing that liquidity from the market?
Right. I mean, it's by design that no one talks about it. There's no, every time Powell has a press conference, there's one time, one reporter asked about QT and Powell just kind of doesn't answer that part of the question. They want it to be, on autopilot. We'll use that infamous phrase of autopilot. They want it to just run in the background. And so this is exactly what they want. I think that you're right that once if we get into liquidity problems, if that does happen, people were worried about it as they replenish the TGA, but luckily or thankfully, the money came out of the reverse repo, or 60% of that TGA replenishment has come out of reverse repo. So they haven't really had to curtail the roll off of that of the QT. Now, what will be interesting to see is if it's all mostly treasuries because agency mortgage prepayments have been so slow. If we kind of get a sizable rally in rates and prepayments pick up on the agency mortgage side of things, how does that affect liquidity when those numbers are actually much larger than the 35 billion a month? Those prepayments could come in quickly, very quickly, and be much larger than that level. So we'll have to see if we do get that rally in rates and in mortgage rates.
But you also have to think about the coupon stack, right? Like at the Fed's balance sheet, it's primarily 2s and 2.5s, right? So, I mean, you got to have a pretty meaningful rally in rates to get there, but maybe under that premise too, people are trying to sell their homes or something. But one last thing too, before we get into the market side too, is there will be this nice replenishing of the Treasury accounts too in October of this year, because Californians will have to make their tax payments finally. So don't forget that the state of California got FEMA relief for the rains and floods we had out here. And so a lot of your wealthy taxpayers that sit out here on the left coast haven't made any quarterlies and or payments for the fourth quarter of last year either. So there is some tax revenues that are kind of sitting on the sidelines. So people always talk about cash on the sidelines and investing. So there actually is cash sitting on the sidelines. It's actually sitting with Janet with her T-bills. That's what a lot of us are doing. So again, there is going to be some newfound liquidity coming back to Uncle Sam later in the year.
Yeah, don't remind me.
Yeah, unfortunately. So I'm just trying to remind you, like that student loan payment you haven't made in 3 years. Make sure, we haven't made tax payments in like 9 months either. So. Sam, that was your cue to ask.
I was like,
I'm not sure if you're asleep or what's going on over there.
All right. So let's move over to the markets then with that. And I just thought you were going to keep going, but second half of the year, what are some of the big themes that you think are going to play out in financial markets here? So you missed the banking stress, the crisis that never really became a crisis was your response. What do you got for us for the next 6 months, man? It's like, try to call it out.
As I said, this is Sam. This is your least favorite podcast because you have to participate. I think, certainly, you look at equity markets, good first half of the year, tech up 40%. I don't think you can expect another 40% out of tech. I maybe we'll just annualize. I was about to say annualize the first half of the year. tech is up 200% or it'll be up 200% or a double, 100%, a double for tech for the year. Just given that I'm maybe a little bit more bullish on the economy, I think that maybe you get I'll go back to that commodity well again. I think commodities do well, just given if we get that demand side up, if the economy doesn't go into recession, certainly can be more in stocks and more on the credit side of things. But again, same idea as we talked about earlier, the barbell portfolio. You still want to have that. It's not like it's not like markets wait for the recession to come and then they go, oh, spreads are too tight and spreads widen out on your credit risk. They widen out going into a recession. They see the signposts of a recession coming, and so you still want to have that. Even though we're not getting a recession this year, or if we're not getting a recession this year, that you still want to have that barbell side, that flight to safety side, and your long duration Treasury side, to kind of take some of the edge off of that spread widening that would occur before a recession comes.
And looking at spreads today too, I mean, it does not look very indicative of a recession at this point, right? We got IG hovering around 130, and that's really kind of a triple B type of rated asset these days. You've got the high yield market. What is it? It's in the kind of low 400s right now in terms of spread. I like to actually think that it's a little bit tighter than that because the high yield market's keyed off of the 5-year part of the curve, right? That's where people quote. But because of the deep inversion of the curve, bills yield 100 basis points practically over that, or at least 75. So I kind of feel like, if you think about the risk-free assets, not necessarily the fives, when you think about that, you kind of think about cash earning there. And then we heard from on the investment call this morning, our EM team is saying, 430, is kind of like the bottom end of the range that they've seen as well. So in general, things look pretty tight at this point, or at least it's not symbolic of us entering into a recession. And so, it sure looks like the markets are kind of in step with what you think about or how you're thinking about it right now.
Yeah, but obviously that won't last. I think that it's okay to stay in those risk assets for we'll call it the medium term, whether that's 6 months or 4 to 6 months before the next podcast that I'll do with you guys, and so it's okay to stay in that side of things. Clip that extra 430 basis points for your EM over Treasuries, and just be prepared to. That's why you have that ballast on the other side of things. So you don't want to take any one-sided risks here, just given that we are kind of on a cuspy point here, and that the labor market turns, if the services side of things turns, that you could start to see spreads widen out pretty significantly, which is what they tend to do when you get a recession. So as I talked about earlier, your convexity on the 2-year looks okay. Your convexity on credit maybe doesn't look as great. So you want to kind of buoy that with the other side of your convexity trade.
All right. So with that, let's sum it all up. Let's do the set it and forget it for the remainder of the year. Are you still 60% overweight bonds to 60-40 to equities?
Yeah, because it didn't work for the first half of the year. Let's go with it for the second half of the year.
Because it didn't work, let's do it again.
That's right.
Let's double down. Right?
The thought process was right. It just, the markets didn't cooperate.
Yeah, the market was wrong, right? Isn't that what we say, right? It's not that we were wrong; it was the market was wrong. And so, as you think about it too, what are you thinking about in terms of this whole developed market versus emerging market as well? As you're thinking about positioning there, I know you said you like the commodities, but how are you thinking about EM equities at this point?
I feel like the emerging markets is in a better, even though you did talk about EM fixed income down at 430 spread, pretty tight. I feel like they're kind of better positioned. The developed markets, we kind of forget that inflation is not just a U.S. phenomenon. It's happening across the developed world, and maybe the Fed is ahead of the curve as opposed to the other central banks in terms of their rate hike cycle, or at least seeing the inflation come down a little bit more. And so I think that your EM, whether it's on the equities or fixed income side, is a little bit better positioned than the DM, ex-U.S. Across both especially in the fixed income. Maybe equities, you haven't really seen, the DM equities, you haven't really seen, they've performed well. You haven't really seen too much of, they were kind of positioned for a little bit more of a recession, I think, at the beginning of the year. And that obviously recession hasn't happened. So I think they're still positioned pretty well from a DM equity side of things.
And then the last area, Sam's favorite asset class that's not a security or is a security. We can't figure it out. What's your outlook on crypto?
It is whenever Sam talks about it on the Monday Morning Minutes, he says it's my favorite asset class. Whenever I talk about it, when he's not on the podcast, I say it's his favorite asset class. It's interesting. I think that if you get I'm certainly not a buyer of crypto. You always want to have that, like, the fundamental side of things on what you think is going to happen or how is it going to work out. It's, if you want to take a flyer on it, put a percent in crypto, even though Bitcoin's up 80% or something so far this year. Call it 82% this year. I still think that it's not going to 1 million like some people were talking about a couple of years ago. But certainly you have your treasury portfolio as your ballast. If crypto takes off, you don't want to be left holding with none of it. Throw a percent or something on there, and if it goes to 1 million, then at least you have a good story. If it goes to 0, you have a good story to tell. If it goes to 1 million, you have a good story to tell.
What if it sits at 30,000?
Hey, it's didn't go down, so
yeah, opportunity cost, right?
Yeah.
So all right. And then, all right, so lastly, let's talk about the asset allocation mix. How are you thinking about it all between the equities, bonds, and commodities? And then you got to save your 1% for crypto. You can obviously add cash in there as well.
I think it's okay. We talked about it. I was like, we were saying 10% cash. I was saying 10% cash beginning of the year. I think you stick with that. You're still getting 5.5. The 6-month T-bill right now looks like 5.5%. So let's lock in that 55 basis point contribution to total return for the rest of the year on that 10% cash. I think, let's see, I was going 60-40. So 50% in your other fixed income. You want to put, like, a third of that in longer term treasuries and the rest in kind of credit. I kind of would like to avoid the investment grade credit market, as 130 basis points over. I'd rather just go more high yield, more bank loans, more emerging markets, and then the treasuries to give you that duration. So one third in treasuries, 2/3 in credit. And then it's interesting when we talk about the stock market, U.S. stock market. It was a good story through the first 5 months of the year when the S&P equal weight was flat or slightly down. S&P cap weight was up 10%, it was up 10%, yeah. And then subsequent to that, they've kind of moved more in lockstep. So maybe you don't want to be so cap weight heavy in your U.S. equities. Maybe go down. You certainly want to have some S&P 500, but go into the some value, go into some mid and small cap names, or maybe not names, but go into the mid and small cap. And try to diversify away from those big high flyers that have driven a lot and certainly could continue to drive a lot of that return of the S&P 500. But I would not expect them to kind of have that huge outperformance that they did in the first half of the year.
All right, I think that's a good outlook here. So you've now committed to be our first guest on the show in 2024, assuming that Sam doesn't retire. He keeps threatening it every episode. So he keeps showing up still. So thanks, Sam, for showing up once again. And we're going to let you go, Mayberry. You spent a lot of time on it today. But before we do, now we talk about Sam's favorite part of the show. And Sam, you get to participate today. So we have someone bringing in your role today because we want broad participation.
Yeah. So what's typically my favorite part of the show is called Sherman Says. Whenever Mayberry is a guest host here, it becomes my least favorite part of the show. But what Sherman
He's not
says,
a guest host, he's a guest. He's a host on your other show. He's a guest on this show. I know there's a lot of incestuous behavior in here, but still, he's a guest today.
All right, I was trying to slip it in, try to bring it through. So So with that, Mayberry, you know the rules here, but for our listeners out there who might not be familiar, this part is called Sherman Says. I will offer a series of alternating prompts. In this case, it's going to be Kimbrough offering a series of alternating prompts amongst the three of us here, Sherman and Mayberry and me, to which we'll offer a top of mind response.
I like you were about to say myself. You caught yourself.
He was.
For not
Had
saying
to think of the
myself,
context
was
there.
incorrect.
Yes.
Very good.
It works. So with that, Mr. Kimbrough, I believe you have 10 prompts for each of us to give us a little bit of extended Sherman Says for our listeners who definitely ask for it. But this is typically the best time of year or best time to do it when we have Mr. Mayberry on here as the co-host.
Well, thank you for having me on and give the people what they want. So I got you 10 per person. And the order we're going to have here is Mr. Sherman, Mr. Lau, then Mr. Mayberry. And kicking us off, Sherman, let's go ADP employment.
Garbage. Garbage in, garbage out. You would think the people who process the payrolls would know how many jobs there were, but it sure doesn't seem to be.
Well, on that note, then we're going to go to Mr. Lau with non-farm payrolls.
Yeah, I was going to say, I mean, I'll pull into the ADP on that as well. Is ADP's stated goal is to try to front run and predict what the NFP will be by a few days. And I'll go with Sherman's response for ADP there as being garbage, and NFP as being the gold standard within that framework.
Out of 2.
Yeah.
Big sample size.
All right, then moving on to the next one from Mr. Mayberry, we have wage growth.
I mean, it's sustained and it's worrisome for the Fed.
Hear that. Let's go with PMIs to Mr. Sherman.
Strong. I mean, it's a mixed bag as we talked about, but services is strong. I couldn't find anything negative in that last report on the services side. So way to go, America.
So the Bears didn't talk about the report. Just
That's
ignore
right.
it.
Stay strong. Next up, we have inflation week.
Low point, but let's watch for the remaining 6 months of the year for the data prints, because I think it's the June report, right?
I thought that was going to be like in infrastructure week, where it was just like every week is infrastructure week, every week is inflation week.
We got two out of we got 2, I guess.
When is Shark Week? Right? I mean, why is that thing?
I believe that's an August event. I believe Shark Week. I'm shooting from the hip.
Yeah, I'm not a fan of the ocean, so that definitely helps keep that fear going too.
You know what? Hey, moving on to the next one. We got back to Mayberry. We're going with small businesses.
I mean, they're the lifeblood of the economy. We'll just stick with the tried and true.
Fair enough. Next up, rate hikes.
I'm trying to think of what's the opposite of lifeblood. Because they're choking you off. It's like the
vampire.
The vampire, they would suck the blood out of the economy, but they haven't been completely felt yet. And the longer we stay higher for longer, the more pain it becomes on the economy. So I do agree with Mayberry that the data looks decent for now. I think the summer can remain strong. I'm probably a little more short-term optimistic than his medium-termish, but I think that over time, the longer you keep rates where they are, the more incentive people have to move their money to capitalize on that. And I still think when people start to realize that rent prices aren't increasing meaningfully, if we're not getting some significant inflation data, then all of a sudden that 5-handle yield looks very attractive. And so I think that it becomes problematic. You get the other side. So we haven't hit credit yet. It's something I've been talking about all year. The credit side, unless it has to be refinanced, doesn't pay market rates, right? But over time now that more people realize that I can get a market rate on my cash, I think that becomes more problematic. So that's where I get a little more pessimistic over time.
All right, then. Mayberry, yield curve inversion.
No, Sam goes after Sherman.
Oh, you know what? You're correct. Let's go with Sam and yield curve inversion.
It's with us for a while. I mean, based on what we think with the rate hikes there. I think we're going to stay inverted for some time yet until the Fed breaks it, meaning the economy, and then they're forced to drop it by the overnight rate by 200-300 basis points a pop.
All right. Let's go next up. Student loans for Mayberry. Get that correct this time.
All right. As we talked about, they're going to, they could be the catalyst that caused the problem on the economy, on the consumer side of things, and could be the certainly people are not used to making their student loan payments.
Hear that. Next one is residential construction.
Okay, I feel like this is like Kimber on the desk. He doesn't listen to anything we talked about. All these like he says have to do with this, but so sorry, Kimber. Residential construction, we need more of it and quickly.
Sure. And you all touched on a bunch of these as I'm reading through them. It's good times.
Yeah, I have
somewhat related
prompts there to ring them in.
That's for you, Lau, we're going with housing correction.
Waiting for it. Not
Still
sure
waiting.
it's going to come anytime soon. I mean, we're seeing some deceleration, but I think if you're in one of the if you're in cities like Los Angeles, where we're at, I think you're still going to have that demand on back of this low supply there. But when you start talking about areas like the things that really popped off during the pandemic, you get the Boise's. I'm not sure what type of industry they really support. They have to support the prices that you saw there. It's just kind of an extreme example. But even places like Austin, that you're starting to see some declines there as well. But speaking on that too, is you get the influx of people there, you're going to start seeing the big drain on infrastructure out there. They just don't really have the city network set up to accommodate all those people. So on top of that housing correction that they're probably going to feel, or they have been feeling in that area, they're going to start feeling a crunch for resources as well, it seems like.
Yeah, but also you get the nice triple-digit weather as well in Austin. I mean, Texas has been horrible. I read something that said 3 of the 4 hottest days in the worst temperatures ever recorded were last week, right? Just cumulatively across, however they measure it. Which sure didn't feel like it out here, right? Like I'm not going to even tell you what our weather was like because you guys all know, and I don't want anyone to get upset with us. So.
I've heard they only experience about 100 of those days a year, so that's not too many.
Yeah. Where I grew up, that was it. It was called May till September. They were consecutive,
So we appreciate it here on the West Coast. Yeah. Next up for Sherman, we're going lack of competition.
Sounds like winning. Where are you going with this, Kimber? Like lack of competition?
So it's a verbal Rorschach test. This is.
Aren't you out of order too?
If I have no competition, I am more likely to win.
All right.
So you went the other way around, bro. On that, I see Mayberry like smiling and stuff, but that was supposed to be.
That's right.
All right, fine. We'll go
I would
back
say monopoly, lack of competition. That's a monopoly.
Yeah. I put this in a weird order here. I'm
Obviously,
skipping around.
Obviously.
Yeah. Well, you know what? Here, Mayberry, we have higher for longer.
Yeah,
Well,
that's the Fed's goal. Higher for longer. That's what they want.
Well, let's get back on pace here. Go to Lau with loan extensions.
If you're talking about maybe CRE, maybe that's you see a whole lot more of those.
I think regional banks are not doing loan extensions right now. How's that? To anybody, forget to commercial real estate. I'm just saying to anybody. Anyway.
It's time to pay. Going to Mayberry with your favorite asset class. Let's go to Bitcoin ETF.
I think it'll be interesting to see whether that actually happens or not. I think that I would say people are going to continue pushing for it until either the SEC says, gives it a thumbs up or a definitive thumbs down. So it could be a long and arduous process. I think what you have to ask is how healthy is Gary Gensler, right? Because I feel like he's not going to pass it, and everybody got some newfound fervor just because BlackRock filed, right? And so I don't know, if you listen to the guy talk, just because he taught a class on it, he sure doesn't seem to want to approve it. So, or like when does the term expire, or is it just it gets replaced with a new a new president or how does I don't know how that works. So
I really don't know how the SEC chairman works. Yeah, I don't know. I still think it's Sheila Bair. I don't know why. She's like the FDIC. I don't know why I always put her in.
Was the FDIC, yeah.
And she's not even at the FDIC anymore. She used to be.
Correct.
Yeah. So.
All right, getting back to you, Sherman. Actually, on schedule here, we got emergency expenses.
Damn. I mean, everybody has them. You need a rainy day fund. How's that? That's what your T-bills are for.
That's for the safety.
Yeah.
Let's go next. We're going to Lau with $70 oil.
For some reason, all I have is like Timmy Geithner and Hank Paulson in my mind now that you talked about Sheila Bair. But did you say $70 oil?
Yes, sir.
Tractor beam.
Geithner these days. Is he running a hedge fund or something?
I think he might have just gotten out of the industry entirely.
All right.
After the GFC, he just said, I'm out.
I mean, Maiden Lane was his claim to fame, right? So
did I answer the Sherman says? I forgot. Yeah, I did. I said tractor pull.
Si, senor. Next we
have
have
as in like farm equipment pull, but the tractor being pulled.
I think tractors use diesel.
Sounds like they should. Sounds like it, yeah.
Sounds like we should electrify the tractors going forward. Make them quiet. Okay, bro, we're not on schedule. Yep. We have a 6-hour deadline on this podcast. That's this much.
We're through 5 apiece. We're working our way through the second half. Next up is trend following for Mayberry.
It's a diversifier. So, if you're or it can be a diversifier, I should say. And, if you want to invest in that trend following momentum, it's a good way to, get some non-correlated exposure.
Next up, bank lending.
I think it struggles at the regionals still, as there's just concern about deposit flight. I think don't we get earnings on like the Pac West and Western Alliance? I think it's like next week. So I know all the big banks come out this week. So I think it's next week they come out. So be very interesting to see what's going on at some of these smallers and to see if there's, all the troubles are behind us. But I think there's still lending going on at the larger ones, especially if you can, if you have documented income and, you have a decent FICO score, but I think it's getting harder. Prime rate is 8.25 now, by the way, prime 8.25.
It's so high. Next up, hedging costs for Mr. Lau.
So high.
Mm-hmm. Oh.
Hedging costs for you, Mr. Lau.
Yeah, they are expensive.
But you can turn that other way around, bro. If they're expensive, you can go the other way back and turn them into dollars. So unhedge them, right? And get the other direction. So you can invest in and make some money there. That's what a lot of people like European credit too, as a dollar investor, just because, again, you can pick up yield by doing that.
So you just other way around, broed him.
Yeah. I just other way around, broed Lau.
And then I pulled up your regional bank earnings, at least Western Alliance, July 21st.
Ooh, so I'm off.
Close enough.
Okay. Close enough. All right, call me a liar over a few days.
Next up for Mayberry, we have refinancing wave.
As we talked about, it's going to take a significant drop in rates to get a refi wave going.
Makes sense. Next up, productive assets.
Better than non-productive assets?
So to give you the inspiration for that was talking about banks lending. It was in the UK, but lending more towards housing and less so towards productive assets in business. Banks being more comfortable with.
I mean, housing doesn't need to be productive. You got to have a place to live. But I mean, the UK has a big problem on its hand with the resets of the mortgages, right? I mean, that's the problem with all those arms there. And so it's really problematic for their overall economy there. So productive assets are a good thing. You want to own them. You do not want to rent them.
There. Next up, let's do For Mr. Lau, we're going corporate profit margins.
Shrinking. I think they're going to be challenged in the next couple of months until we start to see some give back either from the Fed in terms of rate hikes, or you start to get spending to kind of ramp back up from the consumer side, which have been slowing. I mean, they're not negative, but it's been slowing. Inflation doesn't help. Price inflation doesn't help.
Q2 right around the corner, so we'll see it. Q2 earnings. Let's go. This is kind of the summary of a lot of what we talked about today from Mr. Mayberry, but we have economic second half. One word. One word.
One word. I can say steady.
Next up, last 6 to go. We have AI revolution.
It will not be televised.
I like that.
It'll be AI-ized. I don't know. I've heard it my whole life. Call me a curmudgeon here. But I think there's something. I mean, obviously, our phones now can like dictate, right? I mean, that was the holy grail, like when we first got computers, like 30 years ago, right? I don't even remember the software, but trying to use that stuff was very problematic. So I think there's uses for it. I'm not sure it's going to take over the world, but again, maybe I'm a little curmudgeon-y.
All right, we have next up, kicking the recession can.
Well, it's definitely being kicked. Even when it seems like even when we do get a recession, it tends to be a little bit shorter at these times, just given all the new tools inside the Fed's tool belt, this toolkit, as well as the fiscal side as well. It just seems like both sides, the fiscal and monetary sides, are very recession. What's it called? Intolerant.
Like my cucumber intolerance. Yes, very much. Imagine this, Lau. Like, think about if we have a recession, I don't know, 1 year from today. Can you imagine how bad it's going to look with the right, not wanting to do any stimulus just to let the incumbents burn massively? I mean, wouldn't it feel like it could be pretty painful? Again, it's not to say the right is right or wrong. It's just like the left would do the same thing, right? It's like you freeze out the other side. So just given how contentious things are, I think, if you had a recession that started and percolated during the summer, I think they would everything would grind to a halt and it could get pretty ugly. Again, we'll see. We'll see how much people actually care about their fellow Americans or they just care about politics. But
it depends on if it's like real deep, real fast, like we had in COVID, then they'll come together. But if it's kind of a mildish recession, then I think you're right.
Yeah, and if it's a tech bro recession or a woke recession or something, that you can blame it on something else, right? So again, I try to tune out the politics as much as we can, but that's one thing that concerns me.
Yeah, there's no escaping the election cycle, right? So just don't put.
Yeah, and I feel like it's already started. It's getting earlier and earlier every time. It's like it's almost like a perpetual election cycle, right?
2 years on, 2 years off. It's brutal. Let's go to kind of related carry trade. Mayberry.
Earn that carry, earn the, get that 5.5 T-bill, earn that carry for the next 6 months of the year. As we always like to say, make sure that, especially in fixed income, you're looking at your carry adjusted returns, because the carry is a super important part of that fixed income. It's not all price. It's not price. It's the carry.
Yep.
Income is important.
On productive assets, Kimbrough.
Exactly. You want both. You want
They're
both.
productive if they produce income. That's productivity to me.
Exactly. Last round here. Let's have a little more fun here with MLB All-Star break. Kicks off
Home run
today.
derby tonight. It's home run derby time, and Kimbrough, you didn't think my Giants would be still in it after this crappy little streak they were on, but they're still only 3.5 games out in the West. So even with your pseudo All-Star team and Dodgers, being there, they haven't really put it together either. So anyway, I'm looking forward to Julio Rodriguez tonight. And obviously everybody likes to see Alonso hit bombs. So it'll be fun tonight. The game tomorrow, I'm probably not going to watch, but I will watch the Derby tonight.
It's fair. I'll be watching Mookie tonight. So
Yeah, I don't think Mookie stands a very good chance in that. I'm sorry.
No, I like that he decided to come out there and play. It's
I
just
do
fun.
too.
He's
Look,
embracing it.
he's a gamer. Yeah, he's a gamer. And also Rodriguez in his home stadium. I think the place is going to be electric for him. I'd love to see, a youngin come through tonight. So we'll see.
Let's go next. Let's do summer driving season. Summer vacation time.
You know me, I love hitting the road. So most of all my vehicles that have four wheels are V8s, and I'm definitely going to be, at the gas pump a lot this summer season.
Stay safe out there, man.
Got rid of your V12s?
I can't afford V12s, but I guess my motorcycles make up for it a little bit.
I remember when you taught me the term popcorn for your vehicle.
Oh yeah.
Yeah,
and
I
last
didn't know
up,
what that was. I just said it goes, and he goes, that's the popcorn sound. Yeah.
Last up, Diablo.
Obviously we've been playing video games as a team. Been playing Diablo, but my mind went to Taco Bell hot sauce.
Yeah,
it's lunchtime. It's almost lunchtime, so
it's funny. I was asked what I was playing this weekend, and I had told my wife Diablo 4. She goes, "Well, 3 Diablos was not enough." So I was like, "Obviously not." If that we got stuck into this 4th one. So Kimbro, you're the only one missing. So we'll be welcoming you in hell soon.
I just got it on Thursday, and then Friday and Saturday night I was up past 2 a.m. playing this thing. I haven't been up past 2 a.m. in a long time.
Yeah. So this is what happens on the weekend here at DoubleLine. So, all right. Well, Kimbro, thanks for making the appearance, for coming in and, putting your face to all of your Sherman Says. I'll tell the listeners out there that you usually help Sam and create these. So for our viewers out there on the YouTube channel, you get to see what Mr. Kimbro looks like too. The man behind the Sherman Says. So thanks, Kimbro.
Thanks again for having me.
And thanks again to you, Mr. Mayberry, for being our most frequent guest and for committing. You have the longest commitment, forward commitment on the Sherman Show. We've never had anyone say they would like to come back on a specific date. So, so thanks for doing that with us today. Hopefully everyone enjoyed this. We're trying to keep a little lighthearted on these reviews too out there. As you see, there's a lot to digest for the second half of the year. And, if only we could just annualize this first 6 months of the year, I think we'd all take it. But even kind of flattish from here wouldn't be too bad after an ugly 2022. So thanks everyone for tuning in. Thanks for watching. And we'll be back shortly with another episode soon. Thanks again.